Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
Hello and welcome to Under the Banyan Tree, where we put Asian markets and economics in context, although I must admit it's actually a little more markets than economics today because we've got three equity strategies around the table, and that's definitely a first. My guests today are Prerna, Garg and Adam Chi. We're here to talk about the growing trend of domestic equity sales in Asia. How much of your savings actually is, instead of going to the banks, it goes to the equity market, then to companies that need it to invest. We're going to be focusing on two of Asia's key economies. And I think there's a very important reason to talk about this at this particular moment in time. So there's lots to get through. Let's kick off the conversation under the banyan tree. So I'd like to get into the weeds on this Asia by Asia theme. Prerna, as always, you've looked at the numbers. What have you seen?
So, Herald, the total asset managed in Asia, that is the asset managed by pension funds, insurance companies, mutual funds, that's $22 trillion in size as of today. When we looked at it back in 2012, that was like 13 years back, this was $5 trillion in size. So that's more than four times. That's grown by like 12% at an annual rate.
Average rate, yeah.
This is more than what we anticipated would happen at that time. So there is a lot of wealth in the region that is slowly coming into equity market. And the size is only expected to grow as the region ages.
Yeah.
But Herald, why is it important? Why are we talking about it today?
I think when we started off looking at this in 2012, we were thinking about it. This is important because people saved in jewelry, for example, in India, right? Hey, and they're going to put in stock markets. It's good for stock markets. And that's absolutely right. But I think it has a sense of new urgency now because the way the US is looking at itself, the Americans, is that they want to change the role of the dollar. They believe that the strong dollar as a reserve currency, is something that is a burden to them. And there's talk about them discouraging holding dollars. That might mean that the Americans, the US, as a provider of dollars into the world, at some point in time that they said, we don't want to do this anymore.
And Asian markets have been big buyers of this US dollar
Exactly.
assets.
We're very dependent on this. So you have companies that borrow in it, people invested in it. So if at some point in time there will be sort of a dollar shortage, could be in a crisis or whatever, you need to prepare yourself for that. And that means you want to localize your markets. You want to have more local savings going into local investments. And what a better way to do that than through the equity markets?
So we see that's happening, and this is good for equity market over the long term.
Yeah.
But I would say, even though a large part of money from households, from individual investors has come into equity market in last 13 years, the Asian households are still underinvested in equities.
Yes.
To put this in perspective, only 10% of the financial assets for a typical household, Chinese household, is into equities, be it in form of direct single stocks
10%,
or
right?
10%. The same in US is 45%. So US in households tend to invest much more in equities than what happens in Asia.
That is right. The US is a bit of an outlier here because I suspect in Europe it would be lower, although they do a lot through the pension programs over there. But it's right. In general, Asian households, although they have put so much money already into equities, as you said, from 5 to 22 trillion, the vast majority of money they still have in either cash or in jewelry or stuff like that. So it's time to bring in Adam. Adam, welcome to Under the Banyan Tree podcast. I believe it's your first time
It is.
Here with us in the room. So Prerna just mentioned that Chinese households have about 10% of their wealth in stocks. It's been growing there, I believe. Can you tell something about that? And secondly, how do Chinese households invest? Is it insurance? Is it pensions? Is it mutual funds? Buy their own stocks? What's the trend?
So usually, if you look at the split, it's more towards mutual funds, so collective investments. Of course, retail investors can go ahead and open a brokerage account and invest in stocks themselves. But a lot of these retail investors just simply, they don't want to put in the time time to do day trade or to analyze stocks. So they just simply buy a really good index funds and gain exposure to the equity market this way.
But they're still sitting on a lot of cash, and that's coming into the markets,
of course.
right?
Chinese households are sitting on around 22 trillion US dollars worth of cash. So that's a lot of cash.
That's a lot of cash, yeah.
We estimated that since 2019, 2020, because people are really conservative on buying homes, buying real estate, and investing in equities, there's around 7 trillion US dollars in excess saving they can potentially deploy in investments elsewhere. And of course, one of them can be in the equity market.
And they're buying H-shares at the moment,
of course,
right?
yeah. The H-share inflows year to date from the beginning of this year to now is north of 120 billion US dollars net inflow.
So 22 trillion seems to be the magical number here, because 22 trillion is the amount of cash that Chinese households still hold in banks, and 22 trillion is also the total size of the whole region's asset management business,
That's
right?
the lucky number.
So it's incredible. It means actually that the whole region's asset management industry could double in size if the Chinese just put it all into regional funds. It's remarkable, these big numbers, and that's 44 trillion in total. That's like half the world's size of all equity markets. We're talking about really big numbers here. Question to you, Adam. What has the Chinese government done to stimulate actually households to put money at work?
On the policy side, they really try to step up on how funds are investing in equity markets pretty much since April of last year, when you remember the onshore markets are pretty depressed at the time in terms of sentiment. Yeah. So they're trying to encourage through policies these funds to be quote unquote patient capitals to get more exposure to the equity market, long-term exposure to the equity markets. And following that, we see a slew of policy directions, especially recently for insurance funds. So they dictate that for state-owned large insurance company, at least 30% of the new insurance premium received will be allocated into the local equity markets.
Okay, good. So the story is that Asia as a region needs to be self-reliant, self-funded, if you want to put it like that. We need to mobilize, therefore, the savings in the regions into investments so they were not too dependent on other regions, in particular in shifts in geopolitics in the world. That's quite important. We see that this is happening. China is saying, hey, insurance companies, you need to put more money into equities, and there's a lot of cash that could still all help. That helps support some markets. But I'd like to take a break now and then come back and look at India, because I think we can learn lessons for how India has been incredibly successful in getting people to buy stocks in their own market, right?
Let's do that, yeah.
So we're back and we're going to shift focus to India. Prerna, 10, 15 years ago, the talk was Indians don't really invest too much in stocks because they like jewelry, and there was a cultural thing. Property, Indians only want jewelry and property. Turns out they are massive buyers of stocks to such an extent that that is now the biggest driver of the Indian stock market. And I think we can learn lessons from how India has done this. So the question is, how have they done this?
So, Herald, it's a little different from what mainland China did that Adam just mentioned about. The reforms in China were more focused on the supply side, wherein the government encouraged insurance companies and mutual funds equities. In India, the reforms have been more on the demand side, create more demand for equity products.
So that people want to invest in it.
Make people...
so how have they done that?
So there's this instrument which is called SIP, Systematic Investment Plan. That became a big hit in India. This SIP as a plan was introduced in late 90s, but it picked a lot of momentum only starting 2013-14. So what it happens is it's just a way via which individuals invest in mutual funds. But instead of putting a lump sum money in one go, you sign up for the plan, and say every month a fixed amount would be deducted from your bank account, and that goes into equity plans. Why was it a big hit? Is because the government or the regulators made it super easy for people to buy SIPs. The starting amount, the minimum amount you need to start an SIP is just 500 rupees. That's close to $6.
Yeah.
So by making it very small starting amount, they were able to encourage a lot of people to invest in equities, even the people who were not able to put aside a lump sum cash.
Yeah.
The second thing is they made these SIPs extremely popular by
tax advantages.
Yeah, and a lot of advertisements were made around
education,
investor education. So in last 10 years, we've seen that these SIPs or the flows into mutual funds have become a big driver of equity market. every month close to $3 billion goes into Indian market
right?
just via this mode. And what also worked in India's favor was Indian markets have given very strong returns over long term. And this just increased investors' confidence to put their money into equity market.
Yeah, so that's something that we need to see then maybe in other parts of the region as well. I think, Adam, I believe you once mentioned to me that Indonesia sees a growth in pension funds, right? Because people move in.
Yeah, exactly. So as younger workforces move into formal economy, there's naturally a demand for whether that's public or private pension funds, whether it's mandated by the government or corporates just simply need to set them
because
up.
they had an informal job selling, let's say, cigarettes on the side of the road, and now they work in a company, they do something, and automatically you get there for a pension fund, and you start to put money into the markets. I think these are some really key lessons. We have a formalization of jobs. We have education, tax breaks that governments could think of. You could then also mandate companies and these asset managers, hey, you need to put more money into stock markets to create that confidence. And I think, as I said in the very beginning, I think this is really important that Asia does this at the moment, because we are very dependent on dollar funding, and that needs to probably change over the course of the next years or decades. So it's important that these policies are being enacted on so that the region is more resilient in more turbulent times in the future. That has been incredibly insightful. Prerna and Adam, thank you very much for coming on to the Under the Banyan Tree podcast today.
Thanks for having us, Herald.
Thank you.
Under the Banyan Tree is an HSBC Global Investment Research production. Be sure to listen, like and subscribe wherever you get your podcast. And for those of you who are in and around Greater China, we hope to see you at our upcoming China conference on the 1st and 2nd of September in Shenzhen. From all of us here in Hong Kong, take care, and we'll be back next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.